We'll do it live.
Okay. Well, no.
We'll do it live. Fuck it. Do it live. I'll write it and we'll do it live.
Hello, this is Dylan Moore and Nima Majur of iRead It TV coming to you. We are doing it live. It is May 5th or May 6th? It's May 5th, Cinco de Mayo, that holiday that nobody ever really knows what it's about, but everyone goes out and drinks shitty tequila anyway. I will not be doing that tonight. Nima, how about you?
Hey, I'm in Miami, okay? So,
You just do that every night. Okay, fine, whatever.
but no, Cinco de Mayo is like, it's obviously all over here. Although I think it's a Mexican thing, so it's not necessarily a lot of Mexicans out here.
So we're here today to talk about some banking stuff on the heels of the fact that we had another bank go down, in quotes, and banking prices, various banking prices are starting to tank. I don't know if all over the place is the right term, but I mean, there's obviously it's kind of like a one after the other thing happening right now.
A lot of regional banks are going through this pain right now that we've sort of illustrated in our call about the SVB bank.
Yeah, I wanted to bring that one up because when we went over the SVB bank, Nima sleuthingly looked up the actual numbers of what went on with the SVB bank, the Silicon Valley Bank. And what we were able to determine was there was absolutely no fucking reason whatsoever that bank needed to be shut down. And I believe it's...
Well, that's a very strong statement. I would say their decision certainly seemed very rushed and hasty.
Rushed and hasty, and
shut down.
Our understanding of the banking system is that all the safety nets were there available to catch this bank because it did make some errors that weren't necessarily its fault. I mean, we kind of pointed out it was from the government's mismanagement of regulation and interest rates that put them in the bind to begin with. But the safety net was there to solve the problem.
The problem with SVB Bank was really, on the one hand, is this big portfolio of treasury bonds that they've built up because they thought they could earn better interest on that, which at the time was true. They didn't anticipate this rapid rise in the interest rates. And then the deposit drain on the other side, which at the time when we did the call, I didn't really go into why this deposit drain happened because I didn't really necessarily think that I had identified the cause of that yet. But that's a big question, right? Why did they suddenly pull out their checking deposits? Well, they said people were worried and so many of their deposits was uninsured, blah, blah, blah. So, okay, fair enough. But why did this happen to begin with? Where does this drive come from? Where does this impetus come from to pull money out of the bank suddenly? And then now this is happening in other banks too. There's a cause, an institutional cause that we'll get into later as to what I think is facilitating that. But what I was saying back then is, okay, these deposits were dwindling basically because people were pulling them out. So they needed to replace these funding sources with other funding sources, such as the Fed loan or borrowing from other banks. And that's basically what the Federal Reserve System was created for.
And then real quick, why do they need those deposits? Remind everybody. So people are pulling them out. Why do they need them?
When people pull out deposits, that it means other banks are going to start requesting reserves from you.
Mm-hmm.
So if I move my deposit from Citibank to Bank of America, then Bank of America is going to knock on the doors of Citibank and say, hey, we need those reserves now. So then these reserves start dwindling, and then they had to start liquidating other reserve assets.
And then real quick, just to say the actual numbers, so $42 billion is the amount of money that was pulled out from depositors when they had $17.7 billion on the books in reserves.
Something like that.
Something like that. Yeah. Okay.
So yeah, they had to come up with some, sell some of these bonds. They also borrowed some from the Fed. So these are all the options that we went through. But basically, when we went through how does a bank even get started, they can get money from the other banks or from depositors or from the Fed. But the Fed loans are the most expensive ones. And so now here comes another factor into play that maybe I was downplaying a little bit on our last call, on our last discussion of this. But the fact that interest rates have been raised by the Fed so rapidly now, so beyond expectations, has put the banks in a situation where potentially, some of these banks, at least the smaller banks, where their entire profitability model appears to collapse suddenly, right? They previously had checking accounts deposits that they had to pay no money to the depositors for, and on the other hand, they had loan assets that were making them good money and good revenue. But now people start pulling out those cheap deposits, and these banks had to start replacing them with CDs. Like, for example, the big injection that was done to First Republic from the consortium of banks, JP Morgan and I think B of A and some other banks, that was a $30 billion CD that they basically deposited their money into at First Republic. So those are going to be costing them 5% per annum, maybe 4 to 5, maybe even 6% in some cases. So on the loan side of things, if the bank has a lot of loans that were made during the period of 2020, 2021, like these crazy cheap mortgages that some people got, like 2.9% or whatever. Now, these are long-term loans. And now suddenly, for these short-term deposits, or short-term CDs, savings deposits, loans from the Fed, they have to pay 4%, up to 5%. And the Fed just raised the rates to 5%. So it's conceivable that this exercise of rapidly raising rates has put some banks on the margins into very precarious positions where their long-term profitability model suddenly doesn't work out anymore. The model that they'd been banking on this whole time isn't working out anymore. And I read this in some article, and this was kind of a bit of a light bulb to me. I was considering this possibility, but this is a light bulb. And I couldn't find that exact article, but it said exactly what I'm just saying right now, is that some of these banks, because of this drain of cheap deposits and replacement with expensive Fed loans, deposit CDs, is putting them in a strategic loss position for the years to come under these conditions. And that is, of course, a problem for the shareholders of the bank, for the bank. If all your revenue is being eaten up by these currently higher short-term interest rates, then it's hard to make the case to your shareholders that you're going to be a profitable entity moving forward.
And then I want to add something real quick to this. This is very fascinating, is that it looks like First Citizens Bank is going to be buying up Silicon Valley Bank. And as we mentioned in that show, that there was nothing wrong with the loans, right? The 2008 fiasco was because the loans were bad.
Yeah.
The loans are so great here, banks are fighting each other for them, which is kind of leading into what you're saying right now, that, oh yeah, Nima's pulling up, there was $74 billion worth of loans at the Silicon Valley Bank that they're paying. That's what makes a good loan, is you put the loan out and the lender, which would be the borrower, is making the payments. So why does the bank have to fail if it's producing well?
Right.
And if it's being gobbled up by another bank, and what Nima is pointing out, if a dial was simply adjusted at the Federal Reserve, or maybe multiple dials, right, that puts these regional banks in a precarious position based on how the regulations work and how they need to do arbitrage to make money, that these regional banks go out, their portfolios are still good, and they just get eaten up by larger banks. Is this just behind the scenes skullduggery for the big banks to eat the little ones.
Right, right, and that's the big question, right? Is it an engineered situation? What's going on? Because once again, the aggregate banking numbers seem to be fine, right? The loans and the commercial real estate loans, individual loans, auto loans, all of the credit cards, they seem to be growing, or at least they seem to be fine. There's no collapse like in 2008.
Well, and then to that point, Mike, I was listening to Mike Norman today. He's an MMT financial advisor who does economic and financial analysis based on what he sees, going in and out of the Fed and bank loans and stuff. He was pointing out that bank loans they're still cranking out like nobody's business. Right. And then the jobs report was like plus 235,000. Like we're not seeing the signs that the sky's about to fall.
Well, so I think the way to put this would be, let's say you have a business that produces widgets, right, and sells them at a price, and it uses some natural resource on the other hand to produce those widgets, right? So the cost is for natural resource, and the widgets is what it turns out. Now, what if the cost for that natural resource goes up hugely, but you still have your factories and all these things that can produce these things, but the cost for the natural resource is suddenly now double the revenue that you're making, right? So why can't somebody else buy up this entity and
not have the same problems?
Right, not have the same problems. And the answer is because they get a lower price on the natural resources, right? They get a better deal on the natural resource. The natural resource in this case is the cheap, the deposits from checking account people. Where are all those deposits going now? They're leaving SVB Bank, First Republic Bank, and where are they going? Guess what? They're going to the
Chase. They're going to JP Morgan. They're going to Bank of America. Yeah,
the banks who happen to be buying these entities. So those banks can go, oh, I don't know, I like these loans. I guess they were just shitty at doing business, but we can, for some reason, we're so good at all this, we can fund these loans cheaply. Well, something is going on, I guess. There's some reason as to why these deposits are leaving the system, right? And maybe we can get into that.
Well, we're both scratching ourselves here. I was just speculating on that, which is if we look at the FDIC insurance, right? The FDIC insurance insures every depositor or every account. I can't remember if it's like per account or per institution or whatever it is. But there's a max on it, which is $250,000, which if you're a big company
per account.
Per account. But even per account, if you're a $1 billion company, that's nothing, right? So if that's the insurance, people don't necessarily understand how the banking system works. I do not believe it would be that difficult to create a propaganda scare where people would bail out of a bank.
For sure.
Right? And so if we've got the situation where, like you just said, okay, we had multiple years, pretty much a decade of these super low interest rates. So there's going to be a lot of loans on the books that are at these very, very low interest rates. The Fed cranks the interest rates up, and then all you need is a little scare for people to pull their deposits out, so that bank has to run around and start grabbing reserves from wherever it can. But the lender of last resort, in this case the Federal Reserve, or I guess the CD in the event of First Republic from Chase Bank, is at a higher rate that they have to pay than they're bringing in from these old loans that were made when interest rates were lower.
Yeah.
Right? So, you can see very easily if the Federal Reserve, for example, controls this dial, you would just need to, okay, we've adjusted the dial, release the propaganda dogs. Boom. That's all it took. And then, let's say you had your guy over at the fucking California Commission of Financial something, whatever the hell it was, who has the authority to close down a bank, because that was one of the things we looked over at on our last show about the Silicon Valley Bank as well, is that the commissioner of whatever the hell that agency was called, Financial Innovation something or other, just declared He didn't provide any evidence. He just declared that, oh yeah, it's insolvent and they can't meet their debts. We're taking it over, nationalizing it. Boom. I mean, it sounds very perfect stormy to me, Nima.
But that propaganda wouldn't even work if the deposits weren't leaving this bank in droves. So
exactly, and the propaganda also couldn't work if deposits were unlimitedly insured.
Oh yeah, so
right,
that's the thing. Like this, everything that's going on right now would be avoidable if deposits were just universally insured. On the other hand, actually, I take that back because as I keep trying to get into, let's just get into what's going on. What happened institutionally in 2021, 2022 that is causing these reserves to leave the overall banking system. It's not just that reserves, like we observed, are going from SVB to JP Morgan, right? That flow or that pull is a symptom of an overall drain that's currently going on, that's sucking deposits out of the banking system. And that is something that is deliberate, right? The Fed has launched a program, a special reverse repo facility is what they call it, whose explicit intention is to
soak up reserves,
provide more attractive venues for reserves than the banking system. So it specifically provides a facility for money market mutual funds to pay higher interest than banks can pay on their deposits. So my suspicion is that a lot of the banks that can withstand all of this turmoil are the ones that also happen to be offering money market mutual funds and that are gratuitously tapping this Fed facility. But let's just read what some people have written about this. Okay, this is an article from Reuters from August 2nd, 2022. Analysis: U.S. banks face $1 trillion reverse repo headache. The trillions of dollars in overnight cash tucked away daily at the Federal Reserve could turn into a major headache for banks that could squeeze their balance sheet and impair their ability to lend. Isn't that exactly what started happening a few months later? The Fed's Reverse Repurchase Facility, RRP, has attracted a wide array of market participants, helping mop up excess liquidity in the financial system. Led by money market funds, volume at the reverse repo window has topped $2 trillion for 39 straight days. The Fed is paying a record reverse repo rate of 2.3%. So this was last year, so it's still lower. It's higher now.
Well, and then when we say this reverse repo rate, this is literally just buying treasury bonds, right? We'll pay you this much if you buy treasury bonds, or is this something else?
This is it's like give us your reserves. This is like a savings account, a new savings account for your reserves.
This is in quotes depositing your reserves at the Federal Reserve.
Right. So the way it works, the mechanism, how it works ultimately is the Fed sells you a treasury bond and then buys it back at a lower price.
Sells you a treasury bond and buys it back.
No, wait, at a higher price.
Okay, buys it back at a higher. I follow.
So, but the much easier way to look at it is just it's another savings account offered by the Fed that pays interest, and the interest is whatever they decided it.
Right, and then to emphasize here again, the Fed is separate from the banking system. The Fed creates reserves or destroys reserves because that's its job. So, there's no reason for the Fed to ever need reserves, right? It's not like the Fed needs reserves to do anything. They're just doing this because they have some stated, for some reason, which is what we're discussing here, for some reason they want to get reserves out of the banking system.
Yeah, this is
they're in charge of governing.
This is part of their interest rate policy at the end of the day.
Okay, yeah.
So when you offer a certain interest rate, then you incentivize. If you offer a certain interest rate risk-free, then you incentivize all the players in the banking system to act accordingly, right? So then now, now the banks will have to offer higher rates to savers if they want to have that money clearing back in their direction.
Right. Which is
Right.
another problem, like we discussed before, because if they have to offer 4.5%, and they've got all these old loans for 2.5%, that's
Right.
also a problem.
Right. So the Fed is paying a record reverse repo rate of 2.3%. I think at this point it's probably more like up in the 5% area, because the Fed just even raised the standard window. So it's, I mean, this is just not even a year ago, okay? And it rates, and they're already paying out 100% more than they did back then.
Right.
Okay.
Very attractive for anybody with any money at all going, shit, I can get 5% for free if I put my deposits over there. Hell yeah.
Right. The Fed is paying a record, following its 75 basis point interest rate hike last week. Barclays expects daily reverse repo levels to hit between 2.8 trillion and 3 trillion by the end of the year. Investors are effectively taking deposits away from banks and putting them into government money market funds, which invest mainly in treasuries and repos. These money funds, in turn, funnel cash to the Fed's overnight window. Again, in our last discussion about SVB Bank, I said I don't understand why people don't just put their money in money market funds, in treasury money market funds. It pays better interest than a bank account, than even a savings account. There's no insurance limit on those things because the government can't default. There's no limits on transfers, withdrawals, etc. So maybe I'm one of those people actually but to me,
and I'm tempted to too. I'm like, maybe I should take all my money out of the system and put it in here so I can get a higher interest rate. Right?
By the way, if you listen to our permanent portfolio from maybe 2 years ago or so, I would have said the same thing. For me, it's a standard policy. My cash position goes into a treasury money market fund, not in a bank, right? For many reasons. There's no downside to it. It's only upsides to it. You get paid more, you have more security, etc. So investors are effectively taking deposits away from banks and putting them into government money market funds, which invest mainly in treasuries and repos. These money funds, in turn, funnel the cash to the Fed's overnight window. I don't know what that means, honestly. Repo allocations from government money market funds have increased to nearly 40% of their assets currently, from around 30% at the start of the year. The Fed will shrink its balance sheet by 95 billion per month from September, accelerating quantitative tightening, which started in June. The concern is that the outflow of deposits from banks into money market funds could reduce bank reserves at a rapid pace that could hinder lending activities to financial markets and the broader economy.
So wait, is this kind of like what's supposed to be consistent with what what the Fed is trying to do? Like, in quotes, they're trying to control inflation by sucking up all this money out of the system, which is supposed to slow down lending.
Right. So the idea is that when the Fed raises rates, then banks have to raise interest rates, and that will reduce lending, and then that'll fight inflation. But what seems to be happening rather, first of all, there's no evidence that higher interest rates go hand in hand with less lending. But what is happening right now is they raise the rates so extremely, so rapidly, that the loans that have already been made are no longer profitable for certain banks. So they're now facilitating this consolidation that's going on in the banking industry, if anything. Mm-hmm. Now, it doesn't seem, like you said earlier, right? Mike Norm just reported on the aggregate lending numbers. Doesn't seem like banks are lending less or anything like that. But it is putting some banks in a problematic position as far as their profitability goes, as far as making profits for their shareholders goes. The concern is that the outflow of deposits from banks into money market funds could reduce bank reserves at a rapid pace. So that could hinder. Well, what's hindering lending is not that the reserves are going away; is that the replacements of funding source are too expensive right now. So the bank's profitability calculation for some of these banks isn't working out anymore, because the banks that they've already made can't be made profitable if they replace interest-free cheap deposits with these high interest demanding CDs and savings accounts, etc.
Right. It's to your point. I mean, wherever they get it from right now, the options all seem to point to a higher
Exactly.
interest rate that they have to pay, which is, and it's not just a higher interest rate; it's a higher interest rate that's way higher than the loans that they're collecting on.
Yeah, just a quick note. This is another thing that if the people at the Fed were paying any attention to what is going on right now, if they gave a damn about the problems that these regional small banks are facing, they would cut interest rates immediately.
Right.
There would be no discussion. There should be an emergency meeting at the Fed tomorrow, and they should cut the rate down to whatever these banks were banking on all this time when they were doing business. That would restore normal conditions, right? Now, they could say, well, we're not going to leave it here forever. There's an emergency. We need, but the one thing that could lend support to these banks right now would be that kind of move, because that would, then the problems would evaporate. Even if there's a deposit outflow, they could replace the funding source with a cheap funding source, and they would still be profitable. Maybe not as profitable as before with the zero interest checking accounts.
But they're not going to be in the pinch that we're seeing.
Exactly, not going to be. So this is another thing. Like they're right now they're sitting there. They just raised rates again yesterday or so, which was expected, etc. But there's no curiosity or interest about the.
Well, I don't think there ever has been. I mean,
right.
Let me. I got to think about. I just finished finally Dr. E. Michael Jones' book on economics, Baron Metal, and which is a fascinating book. I gotta email him after I sit down and take some notes because it took me so long to get through the damn book. But he pointed out that when the Federal Reserve was created, the original intention of the Federal Reserve was to help with employment. And then almost immediately after the creation of the Federal Reserve, it was to stifle employment to help with inflation, theoretically. Right? And the attitude of whoever has been running the Federal Reserve has almost always been absolutely no concern whatsoever to the real effects and the real damages that might happen based on the dials that they're turning up and down. And it's all about, here's this arbitrary inflation number that we have to hit.
Yeah, it's an obsession with the correct inflation. It has to be 2% or below, or else all hell will break loose. Right? So they're watching.
Sorry to interrupt. We know from MMT that it doesn't affect the inflation the way that they think it does. Sorry. Okay, that's all I wanted to add.
Well, I mean, also it's kind of funny that and this is always the same, right? Same with KuFid, all the operations that they run, they seem to be super concerned about our well-being as far as inflation is concerned, right? They're so hyper-focused, this inflation number, and like all these years, I mean, forever, it's been, they watch this inflation, and if it pops up a 0.1% beyond what we expected that quarter, then we have to carefully watch that. Now we have to raise rates, we have to clamp down. This tender inflation figure that they are so concerned about for our well-being. But on the other side is like these giant, obvious, in your face, you stupid retard banking collapses going on. And they're like, I don't know. but it's the same, right? Same with the KuFid. It's like, oh my God, there's 10,000 people in this region caught the KuFid, formerly known as the flu, over period so-and-so. We have to institute all these mask mandates, vaccine mandates, all these giant mandates that have harmed people, harmed the economy, harmed people's psychology, harmed people's health. This gigantic, stupid-ass a club of government bureaucracy that they're swinging because they're so concerned. You see about a couple of people coughing,
right? And then after the fact, you're like, oh, look at all this damage that you did. They're like,
sorry, I didn't force anyone. You know, I mean, Justin Trudeau. You know, we didn't force anyone to take vaccines. We just literally said that we're going to force everyone to take vaccines 6 months
and then
ago.
honestly,
And you
do
can't
we really
be on
want
a train,
these?
you can't be on a plane,
Yeah.
you can't be on the street, you can't go to a store, you can't go this. That's all I did, but I didn't force anyone to take the
What?
damn thing.
And by the way, the people who aren't taking the vaccines, do we even want these people in our society anyway? Did you catch that part? The end of the fucking quote from Trudeau.
Yeah. Right. No,
Yeah.
very concerned and very serious people. These angels roaming among us. Let me just finish this article here. The decline in bank reserves could also lead to a spike in the repo and effective Fed funds rates. Well, that's not true. The effective Fed funds is whatever the Fed says it is. This whole repo operation is a part of that thing, right? Similar to what happened in September 2019 when bank reserves dwindled due to heavy withdrawals for tax payments and settlement of treasury purchases at auctions. That forced the Fed, which by the way, the treasury market, they also control that. They sell and buy into that market. So it's not like, oh my God, there's something happened with treasuries. We have to now change the Fed funds rate. It's all one thing, right? You have to understand what they're doing is interest rate policy, and everything together produces the interest rate policy. That forced the Fed to provide additional reserves to the banking system. The drift of reserves into money market funds and away from banks constitute movement of money away from financial markets, said Matt Smith. Investment director at asset management investment director at asset manager Ruffer in London, which has 31 billion assets under management. For now, bank reserves are still concerned abundant at 3.3 trillion, but the decline dollars has been rapid, some market participants said. From a peak of nearly 4.3 trillion December last year, bank reserves have declined about 23%. In the Fed's previous quantitative tightening, Q1, 1.3 trillion in liquidity was withdrawn in 5 years. To be sure, there are other factors that have contributed to the decline in bank reserves, such as asset reallocations and loan demand, analysts said. Money market fund assets. Government money market fund assets have been fairly steady as of July 27 at 4 trillion, up about 0.1% from a week earlier. Data from the Investment Company Institute showed. The shift of deposits to money funds has been a slow process. The Fed's quantitative tightening will shrink its balance sheet quickly, but bank reserves are set to fall much faster as cash shifts out of bank deposits to government-only money funds. We expect money funds to put this cash in the RRP, the reverse repo,
whatever. Yeah.
Reverse whatever. Wrote Joseph Abate or Abate, managing director at Barclays, in a research note. Expectations that the U.S. Treasury will increase bill issuance for fiscal year 2023, which starts in October, could help ease the surfeit of inflows into the reverse repo inflow, analysts said. Abate estimated that bank reserves will fall to 2.3 trillion. This blah blah blah. I don't think you need to get into all this now.
Yeah, no, I think we covered the basic idea, which is that it seems like either someone's completely asleep at the wheel, or someone's intentionally putting these banks in a tight spot,
right,
from the Federal Reserve, so that they fail, and then it just so happens that the bigger banks come and gobble them up.
Right. So let's just look at my illustration. And if you haven't watched the SVB Bank episode, then you should watch it, because we go through exactly the process of becoming a bank and how a bank's balance sheet emerges, etc. But in the step where we make the loan, right? We make the loan to Jim for 100,000. And how is that funded? Well, it's a checking deposit that is marked up for Jim in the beginning, right? He has a checking deposit with us. No reserves are needed at this point yet. And we have a loan. So we owe him 100,000 immediate money. And we have a loan of 100,000 on our assets, on our book as an asset, okay?
Mm-hmm.
So think of the banking system as a whole bunch of banks doing this thing, right? Creating a loan and marking up a deposit, right? And then the deposit gets sometimes drained out if the money has to go to another bank, right? And the Fed sells bonds, so banks have an incentive to put some of their reserves into bonds because it earns more interest, etc. So there's all kinds of manipulation going on in the system that creates interest rates, etc. But before that, it's all this, right? The bank makes the loan and marks up Jim's checking deposit by 100,000, and then Bank of America shows up and so Jim presents a check to buy something, and the person who he buys something from has a different bank. That bank sees the check, comes to us, and blah blah now request reserves from us. That's why I had to borrow reserves from the Fed, and I actually said 5% here at the time, but I was assuming a loan of 10%. Okay.
Mm-hmm.
But let's say the loan, what actually was this was the example I made. Yeah, different example. That was my own example. But checking account. So the overall banking system is basically nothing but banks have made loans and checking accounts
created from those loans. Yeah.
Within the banking system. Okay. So there's a certain expectation of this is the how much checking account money is out there looking to jump from bank to bank as people make payments and all this stuff, right? But now, what has the Fed done with its special reverse repo program? They said, no, there's not. No,
we're going to suck all those out of there.
Yeah, this money is now out. It's now gone. It's going to an entire separate system that we've set up where rich people can park their money and earn a good interest rate, etc. So this money is sucked out of the banking system in aggregate to some extent, and going to these new institutions that the Fed has set up for, I mean, arguably, what other purpose could there be than to sabotage these small banks?
Or even regional banks. I mean, a regional bank sometimes isn't small. I mean, it's small compared to Chase.
Well,
right?
Certainly, SVB, First Republic, they were pretty large banks, actually. So, yeah, but regional banks. But for whatever reason, JP Morgan can deal with this, right? JP Morgan is able to buy this bank, and the deposits are going over to some extent to JP Morgan Bank. But I think it's in part just because JP Morgan is a larger bank, and they may have a lot of money market treasury only mutual funds that they offer as in part of their portfolio to begin with. They have a wealth management arm. I mean, the other banks do too, but JP Morgan.
And then I also wonder how much of these steps are adding a little bit of a propaganda panic for a specific bank. All right, hit that one. Propaganda panic.
Right.
We just need a certain number of people to pull out their deposits, and bam, got them.
Right. I don't know about that. But
I'm entirely speculating with that.
Yeah,
yes.
The general trend is going on right now, where these deposits are coming out of the banking system, and then we end up with a situation where something's got to give, right?
Yeah, it's a musical chairs situation.
Exactly. So they are creating artificial scarcity of these reserves. That's what they've always done by just declaring interest rate. But right now, they're really cranking up with this. They're cranking this artificial scarcity up. And so as a whole, it's not just money going from First Republic to Bank of America, JP Morgan. It's really money leaving an entire system that is the banking system and going into the money market mutual fund system, which some banks offer money market mutual fund. I honestly don't know how exactly it works or whatever, but also there are some investment firms that do this, right? There's firms that only offer funds that do this kind of stuff. So
well, and then I think it's worth pointing out that we do not need a very big tinfoil hat to say part of what the elite, oligarchy, the Illuminati overlords, whatever we want to call whoever has, I'm not saying all the control, but just some control over the financial system. One of the ways they consolidate is to intentionally cause a crash, let everything go to rock bottom, and buy everything up. And I think this is a perfect opportunity for us to kind of see exactly how they're doing that. Yeah. And it's pretty simple.
Yeah,
Turn the dial a little bit and just wait.
So should we get into First Republic in particular now, or let me say
and actually before we do First Republic, I want to address this because we had a listener ask two questions. One we've already addressed. The first one was asking about large banks scooping up small banks, which has been the theme of the whole show so far. The other question was, this guy has heard that commercial real estate is crashing in value, and this has been a major problem for regional banks. That's interesting. I haven't heard that commercial real estate has been crashing in value. Have you?
I have heard that as well. There are a lot of banks apparently that there's some red flags on the horizon when it comes to commercial loans. But at the same time, in aggregate, these loans still seem to be doing fine for the time being, you know. Um, what's perfectly natural, what's going on right now is right after 2020, the real estate market went absolutely bonkers, okay? And now it's coming back down to earth. So you would expect for some activity to look less to be less profitable in this domain, right? That's certainly, I think, a possibility. Bigger picture, if there's like some commercial crisis on the horizon, I don't
Yeah, here,
know
let me.
that.
I pulled this up from Fox News here, which I don't know how reliable this is, and then I will try to figure out my screen share this time.
You know what I find funny, just by the by, all these crises in the past where the Fed has always instantly reacted with, oh my God, we have to cut rates now to stimulate the economy, right? Because low rates could cause more activity, inflation. That's their theory, right?
Right.
Um, all these times when they've done it in the past, most of the time it was bullshit. It was not necessary. It was other issues. It was fiscal lack of support, taxes too high, spending too low, etc. And right now we have the prime situation where you can mathematically present the numbers, where you can show them if these rates were lower, these banks would not have these problems. And their reaction is, I don't know, we're going to raise them by 0.25 one more time. And then we're going to pause and leave it at these levels that are right now crushing banks for a little more. Let's see what happens. You know, that's their attitude right now. The one time when they could actually save some aspects of the banking system, prevent the economy from doing worse, they are not doing anything. You know,
So
kind of interesting.
Yes, let me send you this because I think it's doing that thing where it freezes when I try to screen share. It quit doing it a while ago, and now it's doing it again. Could you open that link up for me? So scroll down a little bit. And then the first sentence here is the commercial real estate market may be headed for a crash that rivals the 2008 financial crisis this year. I love that. Maybe headed. Good. Quality statement there. So the third paragraph in, it says such and such analysts forecast a peak to trough commercial real estate price decline of as much as 40% or worse, as much as 40% worse than the great financial crisis, Shallot wrote in a weekly investment note. More than 50% of the $2.9 trillion in commercial mortgages will need to be renegotiated in the next 24 months when new lending rates are likely to be up 350 to 450 basis points. So is this saying that we've got $2.9 trillion in mortgages that are essentially subprime? They have a floating interest rate.
That's not subprime. If he's suggesting that so he's saying these are all variable rate mortgages.
Exactly. So is he saying
that doesn't necessarily mean subprime?
Okay,
right?
well, I said subprime, not him. My misunderstanding. But if this is true, I mean, I guess this could be a factor too. I don't know how much 2.9 trillion is in the grand scheme of commercial real estate. Oh, I'm sorry. 2.9 trillion is all of it. 50% of it needs to be renegotiated within the next 24 months at the new rates. Got it.
Right. I mean,
well,
just for like some perspective, like the total U.S. Outstanding treasuries is about, I think, 30 trillion. Total outstanding mortgages, etc. I'm not exactly sure, but so we're talking about 1.45 trillion commercial real estate needs to be renegotiated. Okay, that doesn't mean that the borrowers won't be able to pay those new
Well, let's
renegotiated
kind of
rates.
think this out. You can unshare. Let's think through this. Let's say I'm a commercial real estate owner, and I got a small strip mall of like 10 buildings or whatever, and they all pay me rent. I'm 90% full at any given occasion, and my rates go up, which means my mortgage payment goes up. And for me to handle that, I got to raise the rent on everybody.
Yeah.
And so I guess it becomes a question of, if that's true, does that rent raise affect the business enough that either the business has to raise their prices or the business has to go out of business? Right? So I would put a big maybe on it, because if the business goes out of business and the commercial real estate loses their rent, and that now maybe you have a problem actually making the mortgage payment. But yeah, I mean, it's a maybe, it's a stressor, but to your point, I don't know if they're not going to be able to make the payments.
The bigger question is, how's the economic support from the government going to be over the coming months, right? So if the economy continues growing, if fiscal continues to be supportive, then the private sector in aggregate will be able to make the payments for these mortgages in aggregate. If there is for example, if there's no deal on the debt ceiling and the government starts sequestering payments, and or if there's an austerity deal that requires significantly higher taxes or less fiscal support than previously anticipated, then there will be a recession. And it could be a pretty bad one. If there's a recession, then yes, these landlords will have trouble paying those commercial. And we'll get to Randall Stevens' question in a sec.
Yeah, I just saw it right now.
But yeah, then there's going to be a problem. So it's all contingent upon. Right now, the big factor is really the debt ceiling debate and what's going to happen with that. If there is a resolution, then there's no obvious cause of concern at the moment that's just staring us in the face. If there is no deal, or if there's austerity, then all bets are off as to what's going on. Now the thing is also, the commercial real estate, I found, is always very prone to disaster reporting, because commercial real estate is incredibly volatile. People expect, when they talk about rents and mortgage rates and mortgage payments, they usually think in individual rental terms. But the commercial real estate market is absolutely bonkers in comparison to individual households, residential living, residential rents and mortgages, etc. Commercial real estate rates can go up and down, I mean, ridiculously.
And so could rents, right?
Well, the rents, yeah. I had a buddy of mine. He rented. He was running a business in San Francisco, in the financial district downtown. He was managing an entire floor, basically, of executive office suites, and his rent for the floor from one lease to the other, which was maybe over 5 years or so, it doubled. It went from like 15,000 to 30,000. So these kinds of things are not necessarily all that unusual in the commercial real estate market.
Well, and then there's another thing. I don't know how much this affects the whole system, but in the residential market, your tenant has rights.
Yeah.
Yeah. If they don't pay, depending on your state, it's a pain in the ass to kick them out. And when you kick them out, they may have destroyed the place. In commercial real estate, if they don't pay their rent, you can go change the locks the next day and say fuck you. Yep. Right?
There's more more dynamics. There's more flexibility in the commercial market, whereas in the private market, there's more for private mortgages, renting, etc. There's more restrictions and regulations, certainly.
Well, so I would say, to summarize what we just said about this, the fact that 50% of commercial real estate, $2.9 trillion, is going to have to renegotiate its interest rates at a higher rate within the next 24 months. I would say that, yes, that is a stressor, but depending on conditions, the market, the private sector might be able to handle it just fine.
Yeah. Let me just pull up for comparison, for perspective. Total private debt in the United States, yeah, 18.4 trillion dollars of total private debt. So this commercial market is like 1.4 trillion has to be renegotiated. Maybe not necessarily a huge deal in the big grand scheme of things.
Let's hit Randall Stevens' question here.
Yeah. So it seems the Fed only cares about their mandate, which is to reduce inflation. I guess the health of the regional banks is someone else's problem.
Yeah.
Right. And they can't reduce inflation. That would be a task for the federal government, for fiscal, if anything.
Well, I want to explore that a little bit, because if we go back to Professor Richard Verna, who it seems to be the banking master as far as I'm able to tell, I remember him bringing up the fact that if we look at the purpose of banks, like what's a bank do? That there's a big kerfuffle on what exactly a bank does. And it turns out what a bank does is it creates money for specific things. And there's two categories, general categories, that a bank can create money for. It can create money for productive businesses, or it can create money to purchase assets. For example, a house, stocks, cars, whatever. The money creation for purchasing productive businesses or creating productive businesses is, at least in theory, non-inflationary, because you're creating money and there's more goods and services and employment to go along with that increased money. Versus on the asset side, if you're creating money for just asset purchases, let's just look at real estate, residential real estate for the sake of argument, then you're driving up the prices of the real estate that already exists, and you're not producing anything for it. So the banking system producing money for assets is inflationary, but not for productive businesses. And the argument that at least Professor Werner made was that if the Federal Reserve or any central bank in any country went to their banks and said, "Hey, you know what, guys, chill out on the asset lending for a little while," all the banks would probably do it, because they went, "Hey, the central bank told us to do this, so let's get in line." That would be a way for the banking system / the central bank to be able to address at least one aspect of inflation, right?
Yes. Basically, instead of focusing on this one stupid number, which is an interest rate, which does nothing, they could actually regulate and direct the bank's lending in terms of where the money that they are tasked to create and loan out goes, right? So that would be one way of addressing inflation. That would be an intelligent way of addressing inflation. So of course they don't do that, because they are always, like I've said before, they're obsessed with metrics and numbers that are stupid and easy to follow and communicate and go after. Now, his follow-up questions, but will the raising of interest rates achieve their goal of bringing down inflation?
No.
Well, if they create a recession or a depression as a result of all these bank collapses,
then maybe.
But the thing is, in aggregate, this doesn't seem to be killing the banking. It's only addressing some banks and not others. Although, because of this reverse repo facility that's going on, I actually wonder if that could cause a big panic across the entire banking sector. Currently, the money is flowing from these banks, from these little banks, SVB, FRC, to JP Morgan, Bank of America. Then those banks become part of B of A, JP Morgan. Can those bigger banks, withstand the outflow of this deposits or work around it, or maybe they've already figured out a workaround or a trick to deal with all of that, you know. So
well, and then I do want to add this in here: sentiment from the banks themselves. So I'm in fairly regular communication with banks because I'm in a fairly regular situation of looking for money, and I'm in the process of looking for some business lines of credit, and every bank has its own thing going on, and I'm getting absolutely zero concern of stuff like, oh yeah, we were doing business lines of credit, but things are so freaky right now, we're just not doing those right now. It's more, yeah, come in. Come on in. We got the money to lend. Come on. I mean, there doesn't seem to be any freak out within the banking system right now.
Yeah. So right. So that's important to point out, is that everything that's happening in these banks right now is just on the back end, on the profitability side of these banks. But the loans that they're making are good. The loans they had on the books even are good. It's just that with the expensiveness of the funding sources that these banks are being slapped with now, they have internal profitability issues, right? So now the question, will it bring down inflation? I don't think these rates, one way or the other, are bringing down inflation. Will come down as oil prices come down, or if they come down, and also if obviously if the government if the deficit comes down, these kinds of things would reduce inflation, right? So
if the deficit was applied differently, I would argue.
That too. But even just cutting, like if we're only talking about numbers now, if you cut the deficit, then that reduces income, that reduces spending. That'll also create a recession, by the way, but it would also bring down inflation a little bit. And now he's saying, okay, if not, what would be the best way to reduce inflation from an MMT lens? What would be the best way to reduce? Well, MMT says that inflation, as far as control from the federal government side of things is concerned, just from the fiscal, raising taxes or reducing spending would reduce inflation. Now, there's several factors that affect inflation: the federal government deficit, export surpluses, which we have no control over from a centralized source. These happen in terms of decisions made between individuals buying and selling, and investment spending. So there's something, obviously, you know, banking, the Federal Reserve and the Treasury, they can regulate how banks lend and for what kinds of projects they lend money. So that has an impact on investing. But then again, it's more based on market demand and supply, and what people wanted, what kinds of projects people want to launch, and what kinds of investment products they're investing in, what kinds of things they want to do. Now, I would argue, not even just from an MMT lens, but what's the best way to reduce inflation? Well, actually, MMT would say also reduce the government spending on very specialized types of programs where you have to hire experts that are hard to find, like engineers. For example, military spending is one example of highly inflationary spending. You know, all the money that's spent goes to Raytheon and co. to send their love bombs over to the Ukraine. That does not have a corresponding productive output on the other side. It only has destruction on the other side. But the people who earned the money are going to spend it in the U.S. So there's so many things, you know.
Well, and I think it's also consistent with MMT, to just back up what I was saying before about the assets versus lending for assets versus lending for productive capacity or productive business, is that MMT would say, well, you also have to get control of your banking regulation, right? You got to look really closely at what your banking regulation is creating money for.
Yeah, the banks are the government's authorized lending agents. They're basically extensions of the government. So to say there needs to be banking regulation is not anti-free market or anything. It's completely common sense to for the government to regulate the activities of the government, essentially. You know,
right. And
yeah,
I keep making this quasi joke, you know, turning the dial a little bit. Turn the dial back on those assets, or hey, maybe even turn the dial back on the income requirements for somebody to get a loan. I'm talking particularly on the personal asset side, the houses, the cars, or whatever. One of the big things that banks do is they ask for your gross income. Well, that's not the money you actually have. That's why we have the words gross and net income, because gross isn't what you actually fucking have. Net is what you actually have. So why do banks ask for gross income when they're determining whether or not you can pay a loan back? Just another dial that can be adjusted.
Yeah. So also, there's so much that has been done over the past 3 years to muck up the supply chain. I mean, it's just the level of stupid is absolutely fascinating of what we've seen. So everything to make everything take longer and harder to get and more expensive has been done. And then, by the way, we forced people to inhale CO2 for 2 years straight. So now, and then we forced them to undergo an experimental gene drug injection. So people are, the labor force is tapped out, is getting seriously sick with long-term illnesses, dying to some extent. Athletes are collapsing on the field. There is a reduction in the supply of labor, so that in turn makes things more expensive.
And then there was a reduction in the supply of labor anyway, because the demographics are starting to tighten up.
Demographics aren't supportive. So there's so much that has been done to bring about this level of inflation, which it actually incredibly benign, considering the amount of stomping around that's done by this, elephant in the glass house, basically, has only produced like an inflation at the top of 8%, 9%. That's pretty fascinating to me, actually. That's part of that goes back to the resilience of the US economy, the entire US system in general, right? The US has so much economic dynamics, so much flexibility, so much competition in between states, that the US can afford a lot of stupidity from its politicians for a long time, unlike many other countries in the world. So that's one of the beneficial aspects of this whole system. But just going back to Randall Stevens' question, what would be the best way to reduce inflation? So yeah, I think stopping all the stupidity would have been a great way. Not starting a war in the Ukraine, which has lifted commodity prices, would have been a great way. Long term, also dropping the interest rate to a permanent level of 0.5, 0.25% or whatever. That would also reduce inflation, because it reduces the net subsidy to the private sector from the federal government. Abandoning a whole bunch of government programs in exchange for a transition job program.
Yeah, I think the transition job is one of the big ones.
Yeah, transition job, because it just goes directly to people who consume, and consumption demand can be ramped up easily. It doesn't go into projects and highly specialized sort of entities that soak up a bunch of money but don't produce the corresponding output for society in return. So and these are all things that could reduce inflation.
I think there's also an interesting conversation to be had, and this is something that E. Michael Jones brought up in his book multiple times, is that inflation and a good economy are kind of hand in hand.
Yeah. So that goes back to, okay, why do we even have to reduce inflation, right? That discussion is never. We don't ever have that discussion.
It's just assumed inflation is like the most evil economic thing that can happen. Yeah.
The correct inflation number is this. It's 2%. It's not 2.1. That's bad. Then we need to have lower inflation as soon as it goes. But if it's below 2%, we need more inflation, right? But we know the exact number at which this average figure that is calculated out of a whole bunch of disparate things and markets, consumer, producer markets, there, all this stuff, different products, different price, different availability. Prices fluctuate on the market, by the way. Okay, so it's actually a function of prices to incentivize and disincentivize certain activities in a capitalist system. Not sure. So just saying, I'm not saying that inflation is good, that we should do nothing about it. I'm just saying, tell me how you know what the correct inflation number is.
Well, yeah, and then I think there's multiple reasons why, and let me be clear when I say this, because there's some ambiguity or some argument over what inflation actually means. When prices go up, they could go up for multiple factors. For example, the supply chains could get shocked. It could also go up because you flooded the system with more money than you had products for. However, typically speaking, when we have inflationary periods, even though things get more expensive, in the aggregate, people get more prosperous. Now, oh my God, Weimar, yeah, I know. I'm not talking hyperinflation sort of situation where the productive system collapses. I'm talking about where the money is being pumped into the system at a very good rate. There's employment available, and the unemployment level is low, meaning usually in order to hire somebody, you're not pulling them out of unemployment. You have to bid up from somewhere else to get a hold of them. That's inflationary, meaning things are getting more expensive, but everybody's making more money and getting prosperous. And on the flip side, if you say, okay, deflate everything, people get fired, unemployment goes up, businesses close, and sure, things get cheaper, but people don't have enough money to buy them anyway. Right? So now I'm not saying, okay, if inflation is good, if we have inflation, that means that the economy is prospering. No, I'm not saying that. What I'm just saying is like what Nima said, how do we know that this number is the wrong number?
Right.
Yeah.
So, right. So what MMT, at the end of the day, what MMT says is that you should not be hyper-focused on inflation. You should be hyper-focused on full employment. And so that's why we have the federal transition job, right? So why pay people to do nothing instead of paying them to do something? That should be an easy one to figure out for people. So now I was just saying, if we have this arbitrary goal of bringing inflation down, so then also, by the way, I talk about a lot, what can you do personally,
right,
so that inflation doesn't matter to you? You can start a permanent portfolio, because then you will have assets that will protect you regardless of whether we have inflation or deflation. You will have assets that will protect you from the undesirable effects of inflation.
Absolutely.
So that's the one thing you can do on an individual level. Apply your economic knowledge in that sense. Protect yourself from inflation. If everyone did that, then we could just focus on full employment without even this distraction of if inflation doesn't matter to anyone, then or it does not have this huge impact on people, then that'll be fine. Now, I just want to be clear. The inflation has been pretty bad over the past years, and the eggs aren't on the shelf in some places and all this stuff. That's not good. And there are multiple reasons for why this is happening. Right? There's multiple root causes that we've all addressed: the stupidity in the supply chain, the COVID hysteria,
the population bubble.
Population, well, yeah, the population collapse that is also, by the way, being facilitated and cheered on by the leading oligarchs of this whole Western Atlantic establishment, the ideology. These are all things that can be addressed, but they should be addressed in a more pointed fashion. Here's the problem: but to look at inflation is just looking at one final outcome, this entire compendium of events that
complicated, interrelated things, yes,
that can be addressed and should be addressed individually, right? But to say, oh, but I don't like this inflation, so the rates have to be here and this is here. It's like saying, oh, we have reports of COVID number at this level. Make everyone wear masks.
Shut all the businesses down. Shut all the businesses down. Yeah, stop the international trade. Yeah.
We must do something, right? This is always the the outcry of the mob, the mindless, stupid mob. There ought to be a law. There must be. We should do something. Well, yeah, but what? How? How can you prove that what the measures you're proposing are actually addressing the problem? So now he's saying so they should promote lending that incentivizes an increase supply capacity. Yes, while at the same time reduce lending that doesn't. Absolutely, that's
Yes.
what Dylan was saying.
Yes.
Right. So, the market, so the banking system, the argument against what Randall is saying here would be, but it's a free market. We shouldn't tell banks what to do. What we say is, but no, banks are not part of the free market. Banks are government institutions with some free market profit motive going on that in theory and maybe in praxis too incentivizes innovative behavior on the part of the banks. Okay, but maybe that's not so good. Maybe a lot of the innovation that banks are doing we would be doing better without, you
Right.
know.
Well, and as I've always said since I learned FMT, money is a unit of government. It is not a unit of free market.
Tax token.
As much as that makes Ayn Rand cry in her grave. If money is a unit of government and banks have the ability to create money, then they are part of the government. I mean, it's what Neiman said. I just came from it at a different angle. So that means banks are a regulation. Their existence is a regulation. So if you're a free market purist, well, shit's out the window already.
Right. So
Yeah.
then, so then you can go to Hans Hermann Hoppe's anarcho-capitalist utopia, and work within that, I guess. But it doesn't exist yet. That's the problem.
Well, and then
So-
for people who that may still have their stomach upset about us, oh, these guys sound like they're fucking, I don't know, socialists or whatever, is that when it comes to this free market argument, in terms of the economy,
We'll turn the light on real quick. Keep talking.
okay, when it comes to the free market, specifically for economic matters, I mean, I guess what else would free market be for anyway? But again, E. Michael Jones pointed this out very, very clearly in his book, is that the historical underpinning, the philosophical underpinning of free market capitalism comes from the Scottish Enlightenment, which we could encapsulate in Adam Smith, who is really a economic projection of Isaac Newton. So Adam Smith tries to create a self-regulating economic system that is analogous to the self-regulating universe of Newton, right? The stuff just goes on its own. There's no divine force that regulates that's needed to regulate what's going on, because between the inertia and the gravity, we get perfect motion. So the free market idea is based on this pseudophysics, as Dr. Jones points out, but at the same time, it does introduce a divine aspect, which is the invisible hand, right? So in physics, you have gravity and inertia. So inertia is the strife force. Gravity is the love force. In economics, we have self-interest and competition. Self-interest is the love force, and competition is the strife force. And these two things operating together are supposed to balance out through the, in quotes, invisible hand. That is like the basic assumption of economics. And the free market idea is that, okay, if the government stops messing with stuff, the free market by itself will achieve balance through the invisible hand. There is no evidence. I mean, first of all, there's no evidence whatsoever that that's true. But second of all, in the years and decades after that, or century plus after that, the people who subscribe to this, coming out of the Anglo-American sphere, when it benefits them, they're more than happy to use the government. Oh, hey, country over there who closed your border to us, we're going to bring in the gunboats and blow your port open until you trade, because that's free market. Oh, the gold standard is not at parity like we wanted it to. Well, increase the interest rates and fuck with the market as much as we can to get it where it is, and now it's good. That's free market. Oh, the Irish are starving because all the potatoes are bad. Well, we can't provide any government aid because that would mess with the free market, right? So whenever it benefits them, they're more than happy to use the government to mess with the free market. But if it doesn't benefit them, they're like, oh, but we can't use the government because that would mess up the free market and that would be bad. Yeah, I mean the people who propose this, I mean they're just fucking hypocrites from the beginning. So if you're running around like, oh, we need to get government out of everything, okay, fine. You're forgetting the fact that money is a unit of government, not a unit of market. The market uses it after the fact, but that the people who came up with this ideology did it based on a divine presence of this thing called the invisible hand that doesn't exist. There's no evidence that there's like this balance that things come back into if the government stops poking it. But the people who promoted it are more than happy to use the government whenever it benefits them.
Right. I mean, with the neoclassical economic theory, which is so powerful, it's what I also grew up with to some extent. The belief is that, and they use these supply and demand charts to convey the theory that prices have a market clearing function. They create this beautiful harmony of supply and demand in the marketplace where all the goods are there to supply all the demands that are out there. And they've provided exactly zero evidence for this theory. They've done mathematical charts.
It's just assumed to be true.
To no end. It's just assumed because the theory, right? They go with the perfect theory, the axiomatic truth, just as the Austrian business cycle theory starts with the irrefutable axiomatic truth that everything started with barter, right?
Yep.
Except everything didn't start with barter. So your entire theory starts with an axiom. Like an axiom is a very powerful thing. It's like an irrefutable truth.
Yes.
That if you try to refute it, you actually affirm it in the process. Kind of like if I was trying to say that Zoom calls don't exist, Dylan. Do you understand? Zoom calls don't exist.
Well, you're saying it communicated to me with Zoom call, yeah.
Exactly. So that's an axiom kind of thing.
Well, and to that point, I since winning MMT and all this, the hubris of the money regression theorem, because theorem is a very close cousin to the word axiom. Right? Theorem is true by definition. And the fact that, what was it, Mises who came up with this theorem?
Yeah.
Ludwig von Mises? Is that the fact that he would even call it a theorem where you don't even have theorems in physics. You have the theory of gravity, the theory of thermodynamics, the theory of electromagnetism, right? Theorems exist in mathematics where you're like, okay, we created this universe mentally, and within this mentally created universe that may or may not obey the laws of our own universe, this is necessarily true. Okay, cool. But you're several lines down on the in quote science purity scale by the time you get to economics, because you've now included the free will of human beings, and you're going to use the term theorem. Goddamn. Hubris. I can't tell if you're staring at something or reading something.
Yeah, let's just get into First Republic at least a little bit. That was what we wanted to do this call about. And we kind of did, actually, honestly. I just want to...
We'll see if we can hit some numbers real quick.
I just want to underline that... first of all, I just want to read one quote from this statement, from this article, that exactly mirrors what we were just explaining. So, First Republic, he added, lost so much in deposits, they have to replace that funding somehow. So they're doing it with borrowing. The borrowing will really weigh on their profitability, both in the reported quarter and going forward. Okay? I mean...
Yeah.
Any questions? Isn't that exactly what we just said? That's what happened. But anyway, now let's look at the numbers. I have here, a note here. The change in interest expense, expensive borrowings following the recent industry. Yeah, this is perfect. This is the answer. This is the answer to everything. All the questions you've had. All the questions that people have about First Republic. Here comes the answer. So here's First Republic's first quarter 2023 results. So we have the benefit here with First Republic as opposed to SVB that their quarterly results were due
right before this happened. Yeah.
Right before that on March 31st. So
they're probably due April 30th.
Following recent
Yeah.
industry. Yeah. So you'll see here. Let me see. Following. Okay. So here's a footnote. So let's see what this footnote is for. Financial results year over year. Net interest income was 923 million, down 19.4%. By the way, not so bad actually. That's their income. So that's after expenses. So the same theme as with SVB kind of, they had an income by this time. So I don't really know.
Yeah, it's down, which sucks, but
Right.
it's not negative.
But so what it says here, but I think we'll get to what the problem is. So there's a footnote
Let's go
here.
read the
And also
footnote.
net interest margin was 1.77% compared to 2.45% the prior quarter. So that's
Consistent with what we said before.
yeah. So again, footnote here. In the footnote here, following the recent industry developments, net interest income and net interest margin were and continued to be materially impacted due to the unprecedented loss of deposits resulting in higher funding costs. And here's another note. Deposits were down 40% from December 31st, 2022 at March 31st, 2023, included 30 billion of time deposits received from the large US bank. So that was that bailout, what they called it, from JP Morgan, etc., which was basically a CD.
Right.
They put it in the form of a CD, which is a very lucrative way to, invest the money. The high interest rates, etc., it's not necessarily probably wasn't a big help to these guys. But let's look at
and then look at this. Loans were up. Loans were up. Loans were up 22.6%. So the bank is doing great theoretically.
The widgets are being produced. The factory is producing the widgets. Just the oil that has gotten really expensive. But what I just want to point out, so this was March 31st, right? Okay, so these numbers, they were still March 31st. Then there's bigger outflows that happened thereafter. So I'm guessing that that's what really pushed it over the edge. And now we will see, let me just see, because note the change in interest expense. Okay, so I'll scroll down a little bit here to point out some key figures. So this is selected financial data and ratios that they're listing here, which you see, this is the quarterly report 2023. Yep. This is the comparable. So this was the quarter that ended in December, on December 31st, 2022. This is the comparable last year quarter, right? So revenues are down
to 3 months ago versus comparables to a year ago, right?
Right. So net interest income is down only like 200 million or so.
200 million, yep.
So net income is cut in half, right? So there's a little less, maybe 40% or so. But let's go into some more striking numbers that I came across here. And this really illustrates the crux of the matter. Yeah. So look, interest expense. I want to just focus on this one figure because this explains so much.
Mm-hmm.
This is their expenses for the quarter ended March 31st, 2022, and this is it for 2023.
Holy shit.
In 2022, their total interest expense was $44 million. You understand? March 2022, this was interest rates were lower. Checking deposits were still in this bank. They weren't sucked out of the system. I guess They were actually already at that point, I think, but it was a long-term process that's been going on. It's really
So it went from
hitting
40.
its
Sorry,
end.
I'm getting ahead of you. The interest expense, and this is money they're paying to depositors and money they're paying to wherever they're borrowing money from, say the
Yeah,
Federal Reserve or
CDs,
whatever, right?
CDs,
So
that kind of thing.
goes from 44 million to 974 million, or
Right.
around it goes from 50 million to a billion, 20 times. And despite the fact that it goes up $900 million,
Still profitable.
their net income only goes down 200 million.
Right. And that's
So they were
pretty
doing
amazing, right?
fucking phenomenal.
Yeah, that's the amazing
Yeah.
part, right? That they have these incredible interest cost hikes, and yet they were still profitable. And part of it is because they had more loan income, right? They had more income from loans coming in, but um, still, I mean, definitely a brutal increase in their borrowing costs. And even just compared to the quarter ended December 31st, right? It's
Mhm.
doubled from then.
Yeah, from 3 months ago.
So once again, net interest, but here we see net interest income only marginally.
Yeah, so
affected.
they have 900 million more in expenses and they only lose 200 million in income. That is impressive.
That's
That's
that is-
impressive.
So that was one figure, and there was another.
Wait, go back up.
figure.
Salaries and employee benefits. I want to see that. Wow, I guess they fired a lot of people.
Yeah, they did start measures to reduce executive compensation, that kind of stuff. But then here's one more interesting thing I think that I saw in the balance sheet. Where we can see. Okay, you look at this here. So the one on the right is March 31st, 2022. So it's the comparable quarter from last year. And the one on the left is March 31st, 2023. So the quarter ended January, February, March. So just to look at the composition of funding sources for these guys, okay? So in 2022, they had
No short-term borrowings.
so first of all, they had 72 billion in deposits. And 2023, it's down to 20 billion. They had 41 billion interest-bearing checking, and now it's 23 billion. They had money market checking, 21 billion, now it's down to 6 billion. They had savings accounts. So in total, they had 162 billion in deposits in 2022, quarter one. And then quarter one 2023, they had 104 billion.
So they're down
And-
60 billion.
Yeah, now let's look at short-term borrowings. They had zero short-term borrowings in 2022. So this would be, I'm guessing, the Fed loans,
Right.
the injection. I think let's see, as much 30 billion is included in. Oh, this is in the CDs. Okay, so that's why the CDs number jumped up to 49 billion.
So it's actually more like 30 billion, even lower than that, because we're including the money that Chase bailed them in with for 30 billion. Yep.
So then we have here zero short-term borrowing. Suddenly they had 80 billion in March, right? And almost no FHLB, federal, I guess it's Federal Home Lending Bank or something like that, advances. And then they have 25 billion. I'm guessing these are pretty heavy interest-intensive funding sources, which have eaten into their margin. So I think let's have a look at liabilities and shareholders' equity. We just went into that in aggregate. But the big thing that really jumped out, and Dylan also caught on to that immediately, is this change in, and it's we have to imagine that after March 31st, because that's when the trouble really began for
then it got even worse
for them, right? So that this number just started approaching levels where they sat at the table looking at each other going, well, how are we going to have a profitable entity moving forward under these circumstances?
Yeah. So I mean, I guess the conclusion that I have to draw from this is that when we look at the actual buttons being pushed and the reasons that they're pushing them, is they're either completely fucking asleep at the wheel, or they're intentionally smashing up these smaller banks, and then right after smashing up these smaller banks, bigger banks gobble them up. Now, correlation doesn't necessarily mean causation, but goddamn.
Yeah, I mean,
Right?
correlation, and then just sitting there and avoiding what's staring you in your stupid face, that could imply causation to some extent.
Yeah. Well, correlation may not imply causation, but it definitely implies investigation to determine whether or not there's
Right, it
causation.
warrants.
Yeah.
For sure.
Hey, Nima, I gotta go home. I got kids and shit.
Yeah.
So, I hope this has been enlightening. It's a little frustrating now that you know that the Federal Reserve is pressing buttons stupidly. I mean, I bet you already knew that, but now you really know that the Federal Reserve is pressing buttons stupidly. But again, this is like most financial things at the government level. It's a very easy fix. You just press some buttons in the opposite direction, right? Well, I hope you now know how the buttons need to be pressed, and maybe this will trickle up to somebody who could actually press the buttons the right way at some point. But this has been Dylan Moore and Nima Bajur of Irida TV. We've been here doing it live. You can find us at irida.tv to check out more of our stuff, and you can check out our Forbidden News aggregator at dissentwatch.com that aggregates all news that we know of, which has been banned. Nima showing it off right there. Please head over to dissentwatch.com. You'll find us. We've been banned ourselves on certain areas of the internet. And we own the site, so we can promote ourselves shamelessly. And Nima is pointing out the fact that there is a featured news section that you may, regardless of whoever you are, whether you're a content creator or not, push your news to the featured news section in exchange for some Bitcoin, where you will earn 2 cents. Or excuse me, we will earn 2 cents per click. It'll cost you 2 cents per click to push whatever article you wish to the top at the featured news section. So, Nima, thank you for sharing that. So either head on over to irida.tv or dissentwatch.com, and thank you for watching, and we'll see you next time. Thanks, Nima.